Welcome back to Eric Dong Academy, where we share strategies and secrets to help you achieve success in investing and life. In today's video, we'll explore the golden lessons from Warren Buffett, one of the greatest investors of all time. You'll learn how he began his journey at just 11 years old and the fundamental yet highly effective principles he applied to build his successful investment career. If you're looking for smart investment secrets and want to become a successful investor, don't miss this video. Be sure to subscribe to the channel, like the video, and click the notification bell so you never miss our next exciting video. And most importantly, leave a comment with the phrase "I want success" to show your determination and commitment to succeed in your investment journey. How Warren Buffett started investing at 11 and the priceless lesson about stocks being part of a business. You've probably heard of Warren Buffett, one of the greatest investors of all time, but few know that he started his investment journey at just 11 years old. And one of the key lessons he learned early on was, stocks are a part of a business. When he first entered the stock market, Warren Buffett was no different from a young investor, seeing stocks as just numbers on an electronic board without understanding what was behind them. However, after reading Benjamin Graham's book, The Intelligent Investor, Buffett experienced a significant shift in his investment perspective. He realized that stocks are not just trading symbols, but actually represent a part of a real business. Stocks are not just numbers. They represent the business you own. One of the biggest lessons Warren Buffett learned is understanding that when you buy a stock, you're not just purchasing a trading symbol, you're actually owning a piece of that business. Each stock you hold represents a small part of a company, encompassing everything that company is doing, from its business strategy, products, services, to its management team and competitive positioning in the industry. This means that instead of just focusing on the fluctuating numbers on the stock ticker, you need to look at the soul of the stock, the business you own. To become a smart investor, you need to research the business thoroughly. How does it make money? What are its competitive advantages? What factors will allow the company to grow sustainably in the future? These questions will help you identify promising stocks and make more informed investment decisions. Invest in the business, not just the numbers. Warren Buffett emphasizes that when you invest, you must invest in the actual business, not just the numbers on the price chart. This means you need to assess the company from a more comprehensive perspective. Factors such as profitability, competitive strength, management capabilities, and long-term growth opportunities will help you determine if the business is truly worth investing in. Buffett also shares that he always prioritizes investing in companies that he understands and trusts their long-term growth potential. If you don't understand the business you're investing in, you might miss out on significant opportunities or risk losing money when the market fluctuates. Why this lesson is important for new investors. For those just starting out, focusing only on stock numbers can easily lead to panic when prices suddenly change. However, once you realize that you're investing in a part of a business and not just a faceless stock symbol, you'll have a more long-term and grounded perspective on your investment journey. Understanding the business you're investing in will help ease your anxiety when stock prices fluctuate. Instead of reacting emotionally, you'll be more patient and confident in your investment decisions because you understand the true value of what you own. 2. Don't let the market control your emotions. One of the important lessons Warren Buffett learned from Benjamin Graham's book was how to handle the market's fluctuations. The market is not a teacher, but a partner that you can leverage when opportunities arise. Buffett calls this market Mr. Market, a strange partner with extremely volatile emotions. Mr. Market can be extremely cheerful, valuing stocks at very high levels, but can also fall into a pessimistic state and drastically lower stock prices. The key is you shouldn't let these sudden changes control your emotions and decisions. Mr. Market, the strange partner. Buffett describes Mr. Market as a strange partner you can trade with at any time. However, the interesting thing is that Mr. Market is not always rational in determining stock values. Mr. Market can give fluctuating values at random without any clear reasons, thus creating uncertain opportunities or risks. But the most important thing Buffett emphasizes is, don't let the emotions of the market control you. Emotions and investment decisions. Buffett learned that one of the biggest mistakes many investors make is letting emotions influence their decisions when the market rises or falls sharply. When your stocks rise in value, the excitement and hope can make you think you are a brilliant investor. On the other hand, when stocks decrease in value, anxiety and panic can make you rush to sell, missing out on future recovery opportunities. However, Buffett advises that the market is simply a partner who gives a price each day, and that's the price you can decide to buy or sell at. If you've done your research and truly understand the real value of the business you're investing in, the fluctuations of stock prices should not affect your decision. You just need to be patient and wait until the stock price matches its true value. How to control emotions when investing? Have a long-term view. One of the most effective ways to control emotions in investing is to focus on the long-term view. The market always fluctuates, but if you invest in companies with strong fundamentals, short-term volatility won't matter much. Confidence in your research. To avoid panic when the market changes, you need to have confidence in your own research and analysis. Understanding the business you're investing in will help you maintain your stance when stock prices fluctuate. Only act when necessary. The market can give prices every day, but you don't have to act immediately. If you don't see an opportunity, be patient and wait. This will help you avoid making decisions based on fleeting emotions. 3. Margin of safety. One of the key principles Warren Buffett learned from Ben Graham is the margin of safety, a crucial concept that helps protect investors from unnecessary risks. The margin of safety is the difference between the intrinsic value of a company and the price you pay when purchasing its stock. Investing in a stock with a high margin of safety means you can withstand short-term price fluctuations without worrying too much about losing money. What is the margin of safety? The margin of safety can be simply understood as a safety buffer you create when you invest. For example, if you estimate the intrinsic value of a stock to be $100, but the stock is trading at $60, you have a margin of safety of $40. This means you have a safe gap between the intrinsic value and the market price, and even if there are short-term fluctuations in the stock price, you can still protect your investment. Why is the margin of safety important? Warren Buffett applied this principle to his investment strategy early on. He understood that when a stock's price is much lower than its intrinsic value, the risk of losing money is significantly reduced. This also helps you maintain confidence throughout your investment journey, even when the market experiences unpredictable fluctuations. If you buy a stock at a price higher than its intrinsic value, you are putting yourself at risk of facing significant losses if the market adjusts. Therefore, seeking investment opportunities with a high margin of safety helps protect your assets and minimize risks. How to apply the margin of safety in investing? Evaluate the intrinsic value of the company. To apply the margin of safety, you need to have a clear understanding of the intrinsic value of the company you're considering. This requires analyzing key factors like revenue, profits, growth potential, and the company's competitive position. Once you grasp the intrinsic value, you'll easily recognize when the stock is priced below or above its real value. Look for undervalued stocks with high potential. One simple way to find a margin of safety is to seek stocks that are priced lower than their intrinsic value. However, you also need to ensure that the company has long-term growth potential rather than just focusing on short-term factors. Be cautious with market risks. Even with a margin of safety, you must remain cautious about market factors. Don't let short-term fluctuations cause panic. The margin of safety allows you to accept these fluctuations without being overly affected. Real-life example of the margin of safety. Imagine you're investing in a company with stock trading at $50. After research, you estimate its intrinsic value at $75. Therefore, you have a margin of safety of $25, meaning you can tolerate a 25% drop in the stock price without worrying about losing money. This is one of the strategies that helped Warren Buffett become one of the greatest investors. He always seeks investment opportunities with a high margin of safety, which minimizes risk and maximizes the potential for sustainable returns. Number 4. Focus on companies with long-term competitive advantages. One of the key investment secrets that Warren Buffett always applies is focusing on companies with long-term competitive advantages. This means you should look for businesses that are not easily surpassed by competitors. A long-term competitive advantage allows companies to maintain their market position over a long period and generate sustainable profits, even as the business environment changes. What is a competitive advantage? A competitive advantage is the factor that allows a company to maintain superior performance compared to its competitors over the long term. These companies not only have good products but have also built a protective system to maintain their competitive edge, such as a strong brand, proprietary technology, low production costs, or an efficient distribution network. A competitive advantage is what enables a company to remain stable and grow in the future. Why is a long-term competitive advantage important? When you invest in companies with long-term competitive advantages, you have less to worry about market changes or the emergence of new competitors. These companies can maintain high profitability for an extended period, regardless of economic shifts or competition. This provides investors with peace of mind, knowing they can hold on to the stocks without fear of short-term value decreases. Warren Buffett always looks for businesses with strong protective barriers to prevent competition from eroding stock value. These companies not only offer good products, but also possess the ability to keep attracting consumers over many years. For example, Coca-Cola doesn't just sell soft drinks. It has built a strong brand that consumers trust and love. With a well-established brand, Coca-Cola can continue to sustain its competitive advantage and maintain market share over the long term. Factors that create long-term competitive advantages. Strong brand. A strong brand helps a company gain consumer trust and maintain steady revenue. Coca-Cola is a prime example of how a brand can become deeply embedded in the minds of consumers. Product or technology monopoly. A company can establish a competitive advantage if they possess a unique product or proprietary technology that competitors find difficult to replicate. For instance, Apple maintains a strong competitive edge due to its innovative and unique technology. Low production costs. Companies capable of reducing production costs often have a significant advantage in the market. Companies like Walmart have built a competitive edge through their efficient distribution systems and cost-effective operations, allowing them to offer products at lower prices than competitors. Strong distribution network. A company with a robust distribution network can easily reach customers and maintain a market advantage. Amazon is an example of a company that has built a powerful distribution system, helping it sustain a competitive edge in the e-commerce sector. How to identify companies with long-term competitive advantages? Analyze products and services. Look at the company's products and services. Are they loved and trusted by consumers? A good product helps the company retain long-term customers. Examine market share and growth potential. Companies with long-term competitive advantages often hold a large market share in their industry and have strong growth potential in the future. Evaluate the management team. A competitive advantage cannot be sustained without a talented and trustworthy management team. Look for companies with wise leadership capable of ensuring sustainable development. Look for uniqueness and differentiation. A company with unique and differentiated products or services will maintain a strong competitive advantage. Pay attention to companies that can stand out distinctly from their competitors. 5. Find companies with talented and honest management teams. One of the crucial factors to consider when selecting a company to invest in is its management team. Warren Buffett, the legendary investor, has always emphasized that investing in companies with talented and honest leadership is one of the key factors for long-term success. No matter how great the growth potential of a company, if the leadership is weak or dishonest, the company will struggle to achieve sustainable growth and provide long-term returns for investors. Why is the management team important? The management team is responsible not only for running the company, but also for influencing the development strategy, investment decisions, and how the company reacts to challenges. If the leadership has a vision and excellent leadership skills, they can help the company overcome difficulties and capitalize on growth opportunities. Conversely, If the leadership is incompetent or dishonest, they could put the company at risk or diminish the value of its stock. Benefits of a talented and honest management team. Long-term vision. Talented leaders often have the ability to spot future opportunities and build long-term strategies for the company's growth. They focus not only on short-term profits, but also on sustainability and the long-term development of the company. Better risk management. A talented management team knows how to assess and manage potential risks, protecting the company and investors' interests. Wise and timely decisions help the company navigate difficult periods without suffering significant impacts. Building trust with investors. The honesty of the leadership is crucial in establishing trust with investors. A transparent management team that always provides accurate information about the company's financial situation and strategies will reassure investors and encourage long-term investment. Creating a strong company culture. A talented and ethical leadership team fosters a positive work environment and a strong company culture. This not only ensures sustainable company growth, but also attracts talented employees, enhancing productivity and creativity in the workplace. How to identify a talented and honest management team. Check the background and history of the leadership. Before deciding to invest, research the members of the leadership team. What successes have they had in the past? Do they have experience in the industry and the company you're considering investing in? Their personal records can help you assess their leadership capabilities. Evaluate the company's key decisions. Another way to determine whether the management team is talented is by looking at the major decisions they have made in the past. Have they made wise decisions? Do they know how to handle crises effectively? Monitor their statements and actions. Companies with honest leadership will always communicate openly and accurately about their financial status and issues within the company. They don't hide or provide misleading information. Transparency in sharing information with investors is an important sign of honest management. Listen to feedback from employees and partners. Talented leaders are often highly regarded by employees and partners for their leadership style and work ethics. If possible, seek feedback from those who work directly with the management team to get a clearer understanding of their qualities. Example of successful management teams. A prime example is Apple under the leadership of Steve Jobs. Steve Jobs was not only a great innovator, but also a brilliant leader who transformed Apple from a company on the brink of bankruptcy into a global tech empire. Jobs had a far-reaching vision and always emphasized product quality, which helped Apple maintain a sustainable competitive advantage. Furthermore, he always had a strong, talented, and honest management team, which built a solid foundation of trust with investors. Advice from Warren Buffett. To become a successful investor, you don't need to chase hot stocks or use market tricks. Instead, apply the fundamental yet incredibly important principles that Warren Buffett learned from Ben Graham. View stocks as part of a real business. Don't let emotions drive your decisions, and always seek opportunities with a margin of safety. If you follow these principles, you'll build a sustainable and effective investment strategy. We've now explored the crucial investment principles that Warren Buffett learned from Ben Graham and applied to become a billionaire investor. What do you think? These lessons are not just simple, but incredibly powerful and can help you build a solid foundation for your investment journey. If you found this video useful, don't forget to like, share, and subscribe to the Eric Dong Academy channel to continue receiving valuable investment knowledge. Hit the notification bell so you don't miss any new videos. Finally, leave a comment with the phrase, "I want to succeed," to affirm your determination and actions. We will meet again in the next videos with more useful investment strategies and secrets. Thank you for watching, and I wish you success in all your investment decisions.